Thank you very much. And thank you everyone for coming and listening to what I have to say about frontier markets, which is a pretty stark contrast to the speakers that have spoken ahead of me. We are an investment company rather than an operating company, and they've spoken to you about very specific opportunities, and I'm going to talk to you about a very broad opportunity. But despite the fact that it is a huge opportunity encompassing a huge range of markets, it's quite a difficult one to access. So maybe just start with a show of hands. Does anyone here have an investment in frontier markets already? 3 hands. Excellent. I would have been out of a job if you'd all put your hands up. So yeah, frontier markets. 3 questions really to answer this evening in 20 minutes. What are they? Why would you invest in them? And why would you do it through the Advanced Frontier Markets Investment Company? So talking to the first, this slide hasn't come out particularly well, so I'm going to have to use my laser pointer to highlight some of it. Frontier markets are basically a collection of around 50 markets as we define them, and it's all those markets that don't qualify for either emerging or developed status. And that is either by virtue of the fact that they're very small, or by virtue of the fact that their stock markets are very small. So either a small economy or a smaller undeveloped stock market, which may not sound like a great advertisement for investing there, but I'm hoping that in the subsequent slides I will convince you. So looking geographically, the largest market in Latin America, the largest frontier market in Latin America is Argentina. It has the dubious accolade of being the only market in the world ever to be a developed market, then to be an emerging market, and then to find itself as a frontier market. And in the space of the last couple of years, speculation has been growing that it is eventually going to make its way back from frontier to emerging, which would be a huge step in what has been a pretty drawn-out and sorry saga. Then most of Africa would qualify as frontier, with the exception of South Africa. So that includes some huge markets like Nigeria. It's the largest population, the largest economy in Africa, bigger after a GDP upgrade that happened in 2014. People pay a lot of attention to statistics, and one of the remarkable things about frontier markets is that the statistics are often so wrong, it's just not funny. So when you have a recalculation or a rebasing of the total GDP of Nigeria, and they realize that actually they've underestimated the GDP of that country by 50%, it leapfrogs to become a larger economy than South Africa. That gives you a kind of measure of how lacking and how poor some of the data in these markets can be. All of North Africa, so markets like Tunisia, Morocco, Egypt, most of the Middle East, which is obviously frontier by name but not by nature. You have in there some of the countries with the highest GDP per capita of anywhere in the world. Places like Saudi Arabia, places like Kuwait. Kuwait is one of the largest frontier markets out there, but it certainly is not poor. It's a frontier market because, as we say, it doesn't like necessarily to work hand in hand with companies like MSCI to include themselves in indices, to open up to have options exchanges, to have foreign banks come in, to have foreign owners taking large stakes in companies. So frontier by name, not by nature. A good chunk of Eastern Europe, a good chunk of Central Asia, heavily commodities dependent, but countries like Kazakhstan and basically any other country ending in stan is going to be a frontier market. And then over to Asia, some very large and very promising frontier markets, Bangladesh, Pakistan, Vietnam, and then all the way down into some of the smaller economies that don't really have stock markets yet, so they're pretty much uninvestable, places like the Solomon Islands and all of these places that are incredibly poor but far too small to even register on our scale. So a very broad universe, as I said, about 50 markets, not all investable yet, but some of them are getting there. So why would you invest in frontier markets? We think 5 very good reasons. The first one is high growth. In a world that's lacking in growth, you can find an awful lot in frontier markets. The fact that they're not necessarily that developed does not mean that they're not growing. They are undeveloped, but they are developing very rapidly, and that translates into growth. Very attractive valuations. We think frontier markets are far and away one of the most lowly valued asset classes anywhere in the world. We look predominantly at equities, but also fixed income in frontier markets, which is something that we are looking at increasingly. very attractive valuations, which, if your timing is right, can translate into very attractive rates of return. They're uncorrelated, so for a portfolio investor, if you invest the way we do by building a diversified portfolio across a number of these markets, you can achieve very low volatility. So they might sound very risky, but actually the volatility of our fund since we launched it in 2007 has been lower than the S&P 500 and lower than the FTSE All Share, which is very surprising to many people that we speak to. And they're under-owned by foreign investors. So these markets are not owned by foreigners. You don't have money pouring in and pouring out through ETFs on a daily basis, depending on what the Financial Times says. They're owned by local investors, local families, and predominantly by local pension funds, actually. And finally, the ultimate reason, because you can make money in them. We think you can make very good money in a lot of these markets, and again, we'll develop that theme a little bit. So first point that we made, growth. Being a low-income country doesn't mean that you're not growing. And in fact, the IMF's definition of low income is a country with a GDP per capita of less than $2,500, which to most people in this room will be utterly unthinkable. But that is a pretty magic number. When you go past $2,500, you start buying things, you start spending money, you start consuming items that you cannot do when you're basically subsisting. That encapsulates a good chunk of the frontier, and obviously there is a huge deviation in growth between individual markets, but it's not uncommon to find markets growing at 7 or 8% in real terms, so that's after inflation. And then GDP growth is nice, but it's not everything. Earnings growth is something that we prefer to see. You want to see companies growing earnings, and we see a lot of companies growing earnings in double digits in frontier markets, again at a time when a lot of companies in developed markets are actually struggling to grow earnings at all, and they're growing those earnings without the benefit of leverage, because basically there isn't really a credit market in a lot of these markets. So in terms of valuation, you can see that the frontier markets down the bottom, trading on 10 times earnings. That's trailing, so we don't believe in forecasting earnings, for 3 years out and then predicting fantastically cheap valuations. This is trailing. This is based on historical earnings, so only 10 times earnings. That compares to 17.5 times earnings for the global equity asset class. They're significantly cheaper than emerging markets as well. And then something else that surprises people a lot when we speak to them is the dividend yield. These companies don't have debt. They're operating in economies where basically you have to function and finance everything out of cash. And a lot of them, as I said, are growing very nicely, which leaves them in a position where they can distribute cash to investors. And the dividend yield on frontier markets is as I say, something that I think surprises a lot of people. Investing at these levels of valuation in the past, you probably can't read the title there, but what it says is the return over the subsequent 12-month period when investing at the current level of valuation. So here we look at the price to book at which the asset class is trading at the moment, and show that up here, historically, when you've been investing at less than 1.5 times price to book, you've done much better than breaking even over the subsequent year, and on occasions you've hit a real home run. Considering you're investing in a very diversified asset class, a return of between 30 and 50% is very nice. And since the middle of January, I think the asset class is up about 15%. So it does happen. Low correlations and low volatility. As I said, you tend to find that these markets are not integrated. They are not. They have not converged with the world. They do not have ETFs. They do not have futures markets. They don't have options markets. They're not that liquid, and they're driven by local factors and local investors. So unlike in the rest of the world, where you have very correlations between individual markets now, it's unusual to see the S&P 500 go down without the FTSE following. In these markets, it's not at all uncommon to see the Pakistani market going up 50% in a year when the Nigerian market goes down 50% in a year. So you see these incredibly low correlations, which when you combine a number of markets and a number of opportunities together, as we do in our investment company, really reduces the volatility. So the volatility of our returns since we started on an annualized basis has been about 12.5%, and for the S&P 500 I think has been about 17%. So we have generated decent returns with significantly lower levels of volatility than you would think just by looking down the list of country names there. So talking of significant returns, what we've done here is taken a long-term chart of some of the core frontier markets that have been frontier for the last 15 years, so the last 13 years. And these are the US dollar returns, including dividends from those markets. As we said, the dividends contribute a very nice part of the returns here. And we've picked 3 markets, not just because they've done well, Kenya, Argentina and Pakistan, but also because they're markets that have been through periods of extreme strife, extreme distress, political upheaval, floods, droughts, famines, violence, elections, you name it. Between them, I think those 3 markets have seen pretty much everything that the world has to offer, and yet they've still delivered exceptional returns. So in Kenya, you've made 11 times your money over the last 13 years, and Kenya is a particularly good example because a lot of that has been driven by technology. The evolution and integration of technology into mobile banking and other such things, into agriculture in Kenya, has meant that the companies there have really been able to generate phenomenal earnings growth. So you've done all of that performance, and yet the Kenyan stock exchange still trades on about 9 times price to earnings, and has some of the best managed companies, we think, in frontier markets. Banks, breweries, cement companies, consumer companies. We really like Kenya a lot, despite the fact that you've already made a phenomenal amount of money in. Argentina, another case in point. For most of this period, going back to, in fact, for all of this period, Argentina has pretty much been a pariah. It's been completely frozen out of global capital markets. It's had a series of heavily related political idiots, for want of a better word, with absolutely no idea how to run a country. Christina Kirchner's tenure came to an end at the end of last year. Political change does happen. I think inflation over that period has probably averaged something like 20% a year, and yet in dollar terms, you've made 6 times your money in Argentina if you've held it for the last 13 years, during which time you have seen an awful lot of volatility. But if you've held your nerve, as I say, you've come out on top. Pakistan, a market we really like at the moment. Again, super cheap, really strong long-term prospects, a big beneficiary of lower oil price, big beneficiary of lower commodity prices, massive population, extremely cheap companies, growing very quickly, and in large part because international companies don't want to get involved in Pakistan. It's not somewhere that they're happy operating, so the locals have a material advantage. And then at the bottom, just for reference, we put in the FTSE All Share, which looks like a rather anemic underachiever by comparison. So additional risks for sure, extra volatility at times, absolutely, but can put them all together and we think you end up with something that's actually a very coherent long-term investment proposition. So that's the asset class. In terms of the fund that we actually manage, Advanced Frontier Markets Investment Company is its name. I'm one of a team of 4 that works on that product. It's a minnow by Aberdeen standards, and I've had several comments tonight already as to what are Aberdeen doing here presenting. You're a giant. Well, we're not. We're a relatively small team within Aberdeen, and we run a listed vehicle, and it's incredibly important to continually market listed vehicles to keep the rating nice and high. So unlike a lot of investment trusts you might look at in more esoteric asset classes, including in frontier markets, we will buy other listed vehicles when they trade at significant discounts to NAV. Our fund trades on about a 7% discount to the value of its underlying assets, which is remarkably narrow. So it is a closed-end vehicle. I think this is very relevant because in an asset class that experiences periodic bouts of volatility, you want a fixed capital pool. You don't want to be forced to be selling when actually you should be buying. And equally, you don't want to be buying, you don't want to have constant cash to invest when markets are running up, when the asset class is incredibly hot, and when the front page of the FT is telling you that you should be buying frontier markets, which hasn't been the case for some time. The objective is long-term capital growth. We are very fortunate to have a very flexible mandate that allows us to invest in a variety of products. So the focus in this fund is certainly best of breed managers, so we spend a lot of time traveling as a team. Two of my colleagues are in Pakistan and Vietnam this week and last, meeting with locally based managers, because Vietnam, again, is completely different from Pakistan. Pakistan is completely different from Argentina in terms of culture, language, accounting, corporate governance, and each of these markets can be very idiosyncratic. So we subscribe to the view that although we're Aberdeen and we manage £290 billion, from time to time you still need to outsource. And I think this is one of those occasions when we are much happy having someone sat in Karachi selecting companies on a very index agnostic basis from the opportunity set there, and someone sat in Buenos Aires picking the best opportunities in Argentina for us. And it's worked very well. We've showed over time that despite what you will read from ETF providers, active managers can work, just not if they're managing hundreds and hundreds of billions in a very, very boring fashion. So we invest with very active stock pickers who run concentrated portfolios, combine them all together, and you end up with something that is a lot more diversified even than the index or than any other competitor fund you'll see in investing in frontier markets. We also buy other investment companies, as I said. It's human nature to be emotional, and we see it time and time again. This cycle repeats time and time again. People sell things when they shouldn't. The old adage from John Templeton, when there's blood on the streets, buy. And we actively try to employ a very contrarian approach. A good example at the moment would be something like Nigeria. The Nigerian economy is basically on its knees at the moment because of the oil price. The stock market has corrected pretty savagely. The currency is expected to devalue. The government is under extreme pressure. The sovereign balance sheet does not look very clever, and yet that is all in the price. To our mind, that's all in the price. You can't find a single person writing anything positive about Nigeria, despite the fact that the oil price has roughly doubled in the last 3 months, which is a huge boost for them. And you can buy companies there trading. You can buy banks in Nigeria now trading at 1 times price to earnings, 0.1 of book, yielding 14%, 15% in cash terms. And that's exactly the kind of opportunity that we like. It takes an iron will sometimes to pull the trigger, but more often than not, it turns out to be the right thing to do. Our fund is about 90 million sterling, and as I say, we think it's the ideal structure for investing in an asset class like this. And then in terms of the portfolio, what's actually in there? So we work with 21 managers around the world. We have managers, as I've said, in Buenos Aires, in Karachi, in Tallinn, in Cape Town, in Nairobi, in Ulaanbaatar, you name it. We've been there and we've spoken to all the locals, and we try to cherry pick who has the very best credentials to invest money on behalf of our clients. It's a concentrated portfolio in terms of managers, but very diverse by country and by underlying stock. So we take conviction in the people we're investing with, and then underlying that, what you see is actually very little stock-specific risk. The discount, as I said, is quite narrow by comparison to other vehicles operating in a similar space, and you can get the full country disclosure on our newsletter, which is on the Aberdeen website. But very briefly, the markets that we are favouring at the moment would include Vietnam, which is an economy that is doing incredibly well in Asia, growing very rapidly, inflation under control, stable politics, really well-managed companies, very entrepreneurial. Pakistan, another market we like an awful lot, same as I said, a big beneficiary of some of the trends that have been playing out in the big picture trends over the last few years. Extremely cheap companies, very well managed, surprisingly good corporate governance. Romania, we own a closed-end fund there, which trades at a 30% discount to its net asset value. It's predominantly utilities, energy, gas, distribution, and again, the standout market in Eastern Europe in terms of stable GDP growth, politics that's heading in the right direction, a really strong reform agenda, and a market that wants to open up and that is aspiring to be an emerging market one day, and taking itself out, promoting itself, and really doing a good job of doing so. Argentina is a big market for us. It could be much bigger in the future. massive political change there, a complete 180-degree turn from what you had a year ago, a very pro-market government just come to power, really well-managed companies that have stuck out 10 to 15 years of really, really tough operating conditions, no leverage. The company has no leverage, companies have no leverage, the country has no leverage. It's a very unusual situation in the world today. They have no leverage because, as I said, they've been basically out of world capital markets for over a decade. Nigeria we've discussed, and Kenya I think we've touched on. I'm running out of time. Yep. So that is the opportunity. So to conclude, a very diverse asset class. We invest in it in a diversified fashion, combining the best bits that we see from the 50 or so markets that you can invest in. Very long-term growth potential, we think great return potential as well. Valuations particularly attractive at the moment. They're the lowest they've been in about 3 years, getting pretty close to where they were during the global financial crisis, which we think is ridiculous given the progress that a lot of these economies have made. And our vehicle, Advanced Frontier, offers investors a diversified way of playing this asset class, which we think is pretty difficult to access any other way. So happy to take some questions.
Questions, anybody? Gentleman over there.
Hello. Do you have problems with safe custody in frontier markets? That's one question. And secondly, will this and sister trust be included in the Aberdeen savings scheme?
To take the second question first, yes, they will. They'll both be going in the savings plan, which I think is a fantastic plan. Investing in an asset class like this by dripping money in on a monthly basis, I think is, money for old rope. I think it's a great way to do it. So they definitely will be, and I'll be one of the first people through the door of the savings plan when it opens. And safe custody is not as much of an issue as you think. The funds in which we invest are all structured as developed market funds. So the custody of our assets is usually with First State or Standard Bank or Northern Trust, big reputable, well-known companies. So no, it's not an issue we've ever experienced a problem with.
Gentleman just there.
What currency are you quoted in, and do you take any steps to manage currency risk?
We're quoted in sterling, so our shares trade like any other shares you can buy on the London Stock Exchange. So quoted in sterling, and we don't manage currency. It's part and parcel of the risk and the opportunity. Currencies go up, currencies go down. In the last few years, mostly down, and in the next few years, I hope mostly up, because a lot of them look extremely attractively valued. And it comes back to what I was saying about the level of economic development. If you wanted to hedge a currency in Africa, you basically have a choice of the South African rand or the Zambian kwacha. And if you wanted to short the Zambian kwacha, you could probably do it in very small size. So there's no means of doing it in most of these markets. If you could do it, it would be extremely expensive. Even in emerging markets now, which are, by contrast, huge in comparison. A market like Brazil, it's still going to cost you 7 or 8% a year to hedge your currency exposure. So you have to be really right, and over quite a short space of time in order for it to work. But our view is very much that currency should contribute over the long term and certainly not detract. If you look at a market like South Africa, the rand has been depreciating forever. I think the rand has gone from 2 to 20 over the last 25 years, and yet you've annualized at 12 or 13% in dollar terms.
Can you talk a little bit about your track record over the last few years?
Yeah, the last few years has not been the easiest few years for us. You learn from your mistakes, and I would say our mistakes of the last few years have been to have probably not to fully appreciate how linked some of these economies were to the oil price, which might sound silly, but actually the economies are not, but the government finances are. So we have reduced our exposure to Africa and the Middle East a lot in the last year and a half. That's completely finished now. I wish we'd done it 2 years ago, but we didn't predict a 75% decline in the oil price. Had we would have had no exposure to the Middle East for obvious reasons. So since the fund was launched, we're outperforming. We don't have a benchmark, but a lot of people will compare us to the MSCI Frontier Index. We're outperforming. We had the approach worked very well going into the financial crisis, and it worked very well coming out of the financial crisis. And since then, it's been a little bit more tricky, but this year is, I'm confident, going to be a better year. It's by no means a disaster. We've kind of been tracking index-like returns for the last 3 years, but for various reasons, mostly asset allocation, we have underperformed. And one of the reasons is we have a 15% country cap. So when you look at frontier indices, they're quite inefficiently constructed. You have 30% weighting in Q8. We have nothing in Q8. They have, in the past, had 35% in UAE and Qatar. Those two got promoted and just vanished from the index. So our view is we ignore the index. We are confident it will work over the long term. In the short term, possibly hasn't worked as well as we would have liked. But I think it's the right way. We're convinced it's the right way to do it, not to put all your eggs in one basket and have a more even spread.
That's all the time. Thank you very much, Andrew. Thank you.